All right, folks, looking at Spotify. Two things. Inside bar. Those two bars triggered. On top of that, not that it's the only reason, it could be the only reason, but it's not. On top of that, we have a hull entry. Now, does it make sense for us to look at anything going forward for a swing trade? Here. Making sure, what do we have? We don't have any earnings coming up in the next few weeks. We're good to go out to June. Let's pull in our trading tool. You can do that. All right. So here's the trading tool. What do we need to do? We need to figure out, okay, we've already decided from a technical standpoint that we want to get long. Or at the very least, entertain the idea of getting long. And I think going out to regular June, perfectly fine. So what do? We go out to regular June. And regular June has an at-the-money vol of about 46.78. We are now trading 183.80. Going out to regular June, like I showed here. And let me, for those that are not familiar, price. I know this is actually not the best color if we're using this. Price. Expiration date, now we need the implied volatility. The implied volatility, what I say is 46.78. Let me get rid of these arrows so they don't confuse everybody. Those calculations, we are targeting, let's just say generically, the 200 strike. Looking between now and June, up or down, essentially 9 to 10%. So if we can get something with the 200 strike, I would be very, very happy with that. The hard thing is that we only have $10 strikes between 210 and 220. I mean, the 210, 220 call spread, if we buy the 210s, we sell the 220s. That almost seems too, excuse me, we're targeting the 200 strike, not the 210 strike. So we can look at a 205, 210 call spread. Man, that seems really cheap. Let's look at the 195 200 call spread. That's 4 to 1. It's trading about $1. That's what we want to do. All right, so that's what I'm gonna look at. I mean, I know we could target a little higher than that. I'm perfectly fine with this. All right, so let me put that together and then we'll get that out there.